Good day, everyone. Well, we've got the Fed that, of course, came out. Not the whole thing with the unemployment report is, it's staying at 5.1%, which is such a meaningless number for many reasons. One of which we indicated in our market write-up this morning. But when you have a lot of people that stop looking for work, and then you take them out of that unemployment figure, it's kind of meaningless. Plus, all the distortions that go into making sure that figure is nicely low on the low end, when the reality is far worse than what these reports say. And the Fed knows it. That's why the CME Fed Watch says that the Fed is going to hike rates in October. They're putting the odds of that at 11%, and I think that's the lowest it's been. So these futures markets are kind of like a crowdsourcing thing. You get a lot of input from a lot of people making bets, and so these statistics can have some greater reliability, certainly greater reliability than some talking head, on the news or someone writing a report, given what they think about what the Fed's going to do next. So this kind of like aggregation of the mass consensus can have quite a bit of predictive value. In fact, there was someone probably knows the name of this company, but what they were doing is they were creating a betting system before movies would come out, and people would make bets based on how successful they thought a movie would be based on a lot of criteria, and the winners would receive money. And the problem was that their predictions were so accurate that Hollywood then, some of these major motion picture houses ganged up and made sure that this company couldn't continue to create these betting pools, because it was hurting the business of some of these films. So anyway, we've got the Fed that's unlikely probably to raise rates sometime this year. They know that the world is weak economically. China keeps taking it on the chin. And I think the markets are telegraphing that. Certainly since the spill in August, they've tried to bounce, but they're having a tough time of it. And we've seen that the S&P has gotten awfully close to retesting lows, well, undercutting lows, I should say. The Russell 2000 has undercut. The NASDAQ is still a bit stronger, but wouldn't be surprised to see also an undercut of its lows as we move into the third quarter here, the fourth quarter rather. So yeah, basically, the commodities world, the commodities picture is not looking any better. It looks, things look like they're in a more or less a continuation of the firm downtrend. You could just type in, also look at USO, the oils, and you can see that the oils are, there was a bounce, but it's not much of a bounce, and it looks like they're trying to perhaps head lower now. They keep retesting this shallow floor, and probably I think they're breaking down through it probably within the next few days. Wouldn't be surprised, especially given that the Commodity Research Bureau Index has already broken through, and it's on the verge of retesting multi-year lows, not far from that point. So yeah, this is it's an interesting market nonetheless. The models have been on a sell signal, and in the immediate term anyway, things are not looking good. So when we put out a pocket pivot report or a viable gap up report on a stock that we think is showing an actionable buy point, it doesn't mean to go out and buy it. It means to maybe watch it and wait for the dust to settle on the overall market, because the market is in a downtrend, and anything you buy is going to have that kind of headwind associated with it. So for like a stock like Play, we did the addendum because there are people who are they like to buy on strength, and in this kind of environment, it's not the best strategy. So if the stock's sticking 3-4% above its 50-day, it's a better option to wait for it to pull back, especially in a weak market, and get it very close to the 50-day, because then if the trade doesn't work out, you end up losing less, quite a bit less. So, and again, this is not the best market to be going long stocks. We haven't really seen too much out there. We do have watch lists, however, and then when we add a stock to the watch list we think is worth watching, we will send it out to our members so they can watch it with us. But it doesn't just mean to go right out and buy it willy-nilly. There's been better setups on the short side. You know, we mentioned Tesla, and that thing is down today. It's come through its 50-day again, and it's a lot of these stocks are looking very problematic. So you know, when you have some profits, by the way, as we always say in these stocks, then take them relative to the context of the chart, because this has been a very tough year, and you want to make sure that that a bird in the hand is definitely worth more than two in the bush, and that's the kind of market we're in. So yeah, with that, I'm going to turn it over to Gil. I'm not seeing anything on the long side for sure that's worth actually playing, but there are some, especially with the market the way it's tried to bounce the last couple days, there could be some stocks setting up. So with that, I turn it over to Gil.
Yeah, I think if you were paying attention last week when we did our webinar, what was that, on Thursday, I think, and we were talking about a number of ideas on the short side. And one basic concept that I discussed last week was this idea that you saw these names like Tesla, for example, had rallied. It had recovered after the August capitulation Monday low, and had rallied back above its 50-day, had a pocket pivot here that stalled, but notice that didn't really go anywhere. And now you saw a number of these names: Tesla, Facebook, Palo Alto Networks was one of them. Even LinkedIn had gotten back above its 50-day moving average. And in my mind, what would signal a break to the downside would have been breakdowns in these stocks through their 50-day moving average. And that's exactly what you got. Friday, you came down through the 50-day just barely on Facebook, and you've broken down hard. And you come down, and let's see, we got 5-minute chart. You actually come down on top of, if you look at the weekly chart, you come down on top of this structure. So that's a logical spot for a bounce the other day. You undercut this low. Now you're trying to push back up into the 50-day moving average, which I think just brings the stock probably up into a shortable range if it got up closer to the 50-day. If you look at Palo Alto Networks, this has actually worked out really well. I saw it as a short on Monday right at the 10-day line because I was anticipating a breakdown here. And remember, on the short side, you don't really want to be reacting. Like if you're trying to put out shorts today, I think you're probably a little late. There's a couple of things you could test. I'll get to those. But you might be a little bit late in terms of trying to short individual stocks right now, because you can see in some cases you got a big break here. This thing comes down into this structure, and it's finding support. Actually, if you draw a line across here, this is what Wyckoff would have called the access line. You can see there's like support here. It becomes resistance here, and now it's trying to be support again here. And I would look at a rally up into the 50-day, which is what, somewhere around 174.85, as potentially shortable. Right now the stock's sitting at 169.90, so that's a pretty good clip from here. And that's what I would be looking for, or the 20-day. Well, actually the 20-day is coinciding with the 50-day. But I think at this point, if you didn't get short some of these based on what I was talking about last Thursday, if you didn't get short some of these on Monday, or I don't know if you would have gotten short Friday, but at least on Monday, when they started to break, you would have got like 10 points or more off of this thing in a hurry. I think close to what was the low here? 164, around 164, 165. So you would have got 15 points out of that if you're shorting it up here. That's what I did. And then you cover it down in here, and it rallies back up. It gets close to the 50-day. You could have put it out again. It's not clear to me what it's going to do from here. I think, though, if I was looking to short, I would just be patient and wait for a rally back up to the 50-day rather than trying to chase it on the downside here. Because this market, I think it's highly manipulated. I don't know. What do you think, Dr. K? Do you think there's a lot of manipulation, or is it just institutions reorganizing their portfolios?
Well, we know that the Fed has been a chief manipulator. Central banks have been chief manipulators since late 2008. It's created this long in the tooth bull market. But on a shorter term level, yeah, you have loads of these algorithms that are trading in operation that create excessive volatility. It's made normal day trading an impossibility unless you have there's a couple tools, like the 620 crossbow that you and I use, and those have proven out. But for the most part, old school day trading is just I think it's a dinosaur now because of these algos that exist. And
Yeah.
yeah, we see that in the patterns, and it's a much tougher market environment because there's much less there's much more efficiency because of these algos that trade quite viciously. So there's less profit opportunity.
Yeah, and the intraday volatility is just nutty. I mean, yesterday uh, you had a nice break in the morning, and usually if I'm short, a break like that within the first couple 3 hours, I think I've told you guys this before, I'll take my profits and go away and see what happens. Because a lot of times you'll see the market at least try and bounce, and then from there you can come after it again on the short side if you want. And that's pretty much what happened yesterday, although the indexes did close a lot better than, close well off their lows, and so it wasn't really something I wanted to come back short into later on in the day, although I did hold some couple shorts overnight, and those are working right now, but we'll see exactly what we get on the downside. I got a quick question for you from somebody, Dr. K. It says here, Dr. K, the MDM has been doing better on the sell side lately. Do you find the index is slightly more coherent, or are they still the same mess? I think I know the answer to that, but I'll let you answer that.
Yeah, well, as I said, in 2011, 2010, MDM did fantastic. 2011, I mean that period where I think it was started in August, where the market got very volatile and seemingly chaotic, but MDM did astoundingly well. I think it was 5 or 6 signals in a row that were all quite profitable, and it's because even though a chart might look incoherent, doesn't mean it is. Incoherence has actually reigned supreme in the last couple of years in terms of market timing because the market looks like it's going to fall apart, and then it doesn't. It gets right back up on its feet, maybe falling 4% off its peak, and so there's no room to make money on the short side, on the sell signal of the model. And I've never seen a market environment and market shape like this. You can go back 100 years worth of market history, and there's just no pattern that repeats like it has. And the reason is because the Fed has been manipulating the markets. This QE has put very shallow floors into these markets. So, and on the long side, the model's done better. There's some signals that have lasted a bit of time, a number of weeks, and then you get some profits out of that. But at the same time, it's been tough to ride a trend because a lot of these trends are seemingly short-lived, because by the time the market might go up a few percent, and then it rolls back over, and it looks like all hell's going to break loose, and it doesn't. It just gets right back up on its feet and goes. And it's the toughest market environment for market timing that I've seen. Interestingly, I hadn't tracked a number of the good market timers that I felt were in competition with me. I did a search for these because I was like, I haven't looked at these guys in a couple years. They're all gone. They're all out of business. Interestingly, there wasn't one man left standing. There is one site. I'm not going to mention the name, but it's a site that I had respect for, but they have completely dropped the ball over the last 3 years, and they're still in business. And I'm not going to say what the site is, but they're a wreck. And I think that they're losing a lot of subscribers because how can you subscribe to a market timing service that's not timing the market properly? But that is the nature of the markets we're in, and again, these kinds of periods do come to an end. I think that the period we're in right now is it's chaotic, but it's more profitable than these last couple of years with shallow floors. I mean, we got a Nasdaq that came off 18% off its peak and then bounced, and that allows for more profitability in terms of the market timing model, but also market direction model, but also in terms of this volatility model that I came out with a beta because I think this is a good environment for it to wet its feet. And I'm still working out a couple things with the model, but I know that model really shines when you get less of this manipulation. So with less QE, the model tends to do better. And my hope is that this QE, the Fed will actually raise rates, say January, early next year, because that might be a restoration back to some level of normality that we haven't seen since, we haven't seen this level of normality in about 8 years. So yeah, I mean, markets, these unusual times, they do come into an end. We're not going to have, I don't think we're going to have this endless manipulation forever and ever. And I think, or I'm hoping rather, that we're starting to see the light at the end of the tunnel when it comes to this QE nonsense.
Yeah, I think where we've been able to shine mostly is in handling individual stocks, and that's really been the way to make money. And I think we've done a reasonable job of that. On the short side, getting back to that, some of the other stocks I'm looking at, and that broke down. You see some of these big stock names. You've seen Amazon bust and broke the 50-day. So now it's pushing back up. It could become shortable around the 50-day, which is around 520 or so. 520, what is that? 521.04. Priceline is another one that broke down, and you can see how it broke down, hit the 200-day. If you're looking at something like this and you short it, you want to cover down here and then try and short again on the bounce. And same thing with Google, another breakdown. This was already below its 50-day moving average, but I would watch these stocks, because if they fail again on these rallies, and you start to see Google and Priceline revisit their 200-day, or Google head for the 200-day and Priceline revisit, Amazon break down further. Maybe that doesn't happen until earnings come out, which is this month, towards the end of the month, I believe, like the third week. And this all might have some implications for the market. I'm watching Apple. I'm actually short Apple. I've been working it short from the 50-day over the last 6 days, and it's come down pretty nicely. I mean, it's about 8% of downside there, which is now down along these lows. Kind of watching it today. Maybe it's a cover point, maybe not. I don't know. Or it may just kind of hang here and then break lower. But I would expect that Apple probably is going lower. You can actually see big head and shoulders forming here. So you already had a late stage failed base up here, which would made it shortable much further up in the pattern. And now you're starting to form this big head and shoulders. It may take some time to play out. But I think it's a big stock short sale target, and you can work it. It's not as volatile, say, as some of these other things like Palo Alto Networks. I think I saw that thing down $2, up $2, down $2, up $2 a few times yesterday. So that's another one of these big stocks breaking. We already talked about Facebook, and again, where they've broken down through the 50 days, you want to look at rallies coming up back into the 50-day moving average if you're going to short them again, or try and enter the, try and enter them. The way I'll work, say in Apple, for example, is shorting it here, and I'm just kind of working it every day and seeing when, kind of feeling it out, see when it's going to break. I came in short some today. It's down $1. I think it got down as much as $1.50 or something like that, maybe a little more. But that's not really what I'm looking for. I'm looking for a break through 100, and that may take some time from here. But in the meantime, that's been one to work on the short side. Somebody says biotech is bouncing. I'm not sure. You must think that we don't have quote systems. I can see a lot of things bouncing, actually. I'm actually looking at half of my short, I'm going to say a third of my short sale watch list is bouncing. And some of those stocks, to say something's bouncing is kind of meaningless. But this one's already way down. I think we talked about shorting this one up here way back when, and it's come down a long ways, and now it's trying to push back up on Baidu. You have Biogen's another one. We were shorting this one back in here, and it's kind of flopping around. Now you're in the 10-day. That might make it shortable. So some of these bouncers in biotechs, they could make them shortable, but a lot of them have been beaten down pretty good. Here comes Celgene right back up into an area of resistance in the 20-day. This may become shortable up here. And you just want to be patient on these, because they break down. They're going to rally at some point. You got to try and figure out where that is. It's not always easy to figure out, but if you look at a weekly chart, for example, you can see that this is actually undercutting some lows here, and you have a closing low here on a weekly basis with the stock here. So, and you actually undercut that this week so far. So there's a closing low right there, and you can see you just barely undercut that closing low. So another thing you want to watch besides intraday lows are closing lows, because sometimes those have more meaning, especially on a day like Capitulation Monday, where a lot of the price action was, in my view, fairly manipulated, and so the intraday lows aren't as meaningful to me. I'm more interested in where the close is. So in terms of an undercut, that tends to make sense. If you shorted it up here and you're playing it with a longer term view, you can probably use a 200-day line as a trailing stop or the 20-day as a trailing stop. Once stocks start to break down, they tend to follow the 20-day moving average to the downside. So that usually serves as a reasonable trailing stop if I'm short a stock further up in the pattern. But I think in most cases, you're seeing bounces today, and a lot of these names are already beaten down, so you wanted to be short them a while ago at the proper spot. And you can see this was a late stage failed base here on a failed gap up, and comes right back up into the 50-day. And look at it's the classic maneuver where it breaks down through the 50-day. So now that's your failure. Your failure is now complete, okay, to quote Darth Vader. And the thing rallies back up. Notice how it stops short of the 50-day, but hits the 20-day, and then it breaks down, and it's fluttering about the 200-day, and then it comes back up a couple more times. This is actually pretty typical action for a late-stage failed base, and it's something you want to watch. But notice how it takes some time before it really starts to break again. Now we're rallying. Excuse me. And it's probably coming into a shortable area. So take a look at Gilead. It's a little bit weaker, and it has been one of the weaker ones. But again, you see the breakdown here, a rally into the 50-day, and now it's just come down pretty steadily. I guess if it rallied up towards 100, and the round number at 100 might represent a pretty decent area of overhead support, that might be a short sale point. So just in general, and I talk about this all the time, when the market's been coming down hard, and I've been making some pretty decent money short, I'm trying to avoid getting giddy and over pressing at the wrong time. I'll try and work myself back in slowly into a bounce. And if the market gaps down without me being short, I won't jump all over everything. I'll look at a few things and see if I want to test some positions, and I'll use tight stops. I may get stopped out right away, and it may mean I'm back testing the next day or two as the stock continues to rally. So you do have to be persistent, but you also have to be patient and wait for these things to come up into the right spot. And sometimes they will come up into the so-called right spot, but they just keep going past, and so you have to have a tight stop to keep yourself out of trouble. Because we could be in a position where you could see a much more considered rally up towards the moving averages, which I think are starting to come. Yeah, here's a 50-day on the NASDAQ. So, I mean, you could see a rally back up. If you go back and look at 2007 and early 2008, late 2007, early 2008, after the major market top in October of 2007, you'll see that the market had come down and actually undercut the 200-day moving average. Here we're way below it, so you might argue we're weaker than we were back then, and I would think we probably are, but we'll see how things pan out. And you rally back up into the 50-day real quickly, and then came back down to the 200-day. So imagine if we go all the way back. I guess I can do that. Let's see. Whoops. Here we go. We'll look at this again because I think it's instructive. And I think if we're going to top here, this is probably more like what we're looking at as opposed to the breakdown we saw in 2000 or even the action right after the May 2010 flash crash, because that was just a correction, actually, in spite of it all. So let's see. Why don't I have a 200-day moving average on here? Oh, I know what's happening. It's taking some time to catch up. Let me go backwards and forwards. Here we go. So you can see what I'm talking about here. You broke down. You notice how you start to look real ugly. You bounced rapidly up towards the 50-day moving average. You don't quite get there, and then you roll over again. You undercut these lows, and of course this looks about as ugly as it can get, but it turns right around, rallies back up towards the 50-day, and then back down again, and then back to the 50-day, breaks down again to the 200-day, and then back up to the 50-day, and then finally you get the big leg to the downside. Now the question is whether today we're looking at a similar situation or whether we're going to break down right away, and that you don't really know. So all you can do is watch what the stocks are doing and play it on the basis of what you're seeing in the individual stocks. So what does that mean? That means exactly what I've been saying here, which is waiting for them to come into the optimal spots for shorting, and then you hit them, and then you see if they work. And if you get stopped out, you get stopped out. I'm getting dizzy here. Okay, there we go. And overall, I'd say the position of the index is you have the Russell undercut. You have the NASDAQ and the S&P retesting, and on a closing basis, you can see, well, actually, this was your close right here. And so you can see that you've undercut those closing lows here on the NASDAQ. So it does set up the potential for a rally from here, even though things look pretty ugly today. And that, that wouldn't be abnormal in my view. And given that we've come down so far over the last couple of weeks, I think that's a good possibility that you could rally, but it would mean just a rally within a potential big sideways bearish range. So. Somebody's asking about CRM. I noticed it had a pocket pivot yesterday, and it's hanging in there. I mean, if you want to go long the stock, I guess you could. You've got some areas you could use a 50-day here or the 10-day as a stop, or keep it tighter than that if you think it's got some legs in it and it can really bounce. Somebody says expect the unexpected. That's pretty much the way you have to operate. So, in fact, speaking of which, you're seeing the market come back. So, maybe it thinks the Fed is just going to flood the system with liquidity. My view has been that they're not going to raise rates. I think I've said this many times before, that the next move they make will actually be QE4. That might be a little radical, but I like to make deep bets, as you might put it, and I think that has some potential there as a possibility. So let's see. So CRM, if you want to try the long side, I guess you could try it. See, as long as you have a stop there. Mobileye, this has been a pretty good punch bowl of death, short sale off the peak here, and the breakdown's been pretty brutal. And so for it to rally, yeah, it could, that could happen. And it's kind of 1, 2, 3 lows, a triple bottom here. Maybe it's going to turn. Who knows? Wouldn't surprise me if it continued up to the 50-day. And that would be, in my view, if you see the extent of this breakdown, that would be consistent with where the stock is in its overall position here. Try to get some support down here in the 42, 43 level, and coming up to the 10-week or the 50-day line would seem normal. You got earnings coming out, I guess, in November. Is that right? Let's check that real quick. Coming out on the 19th. Yeah, so there is some potential there for a rally up into earnings. So then you can see the market coming down hard, and now it's turning back to the upside. So that really doesn't surprise me. There's a little arrow at the bottom right of the chart that jumps you to the present time. You won't get dizzy. Okay, thanks. So where's that? Not here. Nope. Oh, this. Got it. Okay. That's good to know. That must be on the new version. I just loaded this, I'm going to say, a month ago. And I definitely like the new version of eSignal. Although it does have one quirk, and I don't know if anybody else has seen this. Every once in a while, all the quotes, or a good number of the quotes on your screen, will just disappear for a couple of seconds, and then they'll come back. Let's see. How about FIT? There's some talk. It almost looks like it's trying to set up to go higher. It's sitting here along the 10-day line. Maybe it does. I don't know. But I don't know, market down 111, you could easily see it. It could just be bouncing intraday, and you could easily see it roll back over. So trying to take the long side here is also a difficult proposition. I think, someone mentioned CRM. I saw that yesterday on the pocket pivot. That looks like it might have a chance. If you look at something, I was looking at this Radius Health yesterday. It also had a pocket pivot, and it's holding up. And so that's one of the better biotechs. It's had a long run, but you can see that one's held in there pretty well. I had a pocket pivot yesterday. I like that much better than the PLAY, although that is holding up today. But I don't generally, when you see this sort of a break and then you see a pocket pivot, I don't think you need to jump in and buy this. I think if it is buyable, what you can do is, usually what will happen, they need to retest the 50-day one more time, or whatever moving average it is they're bouncing off of, the 10-day or the 50. And so I think in something like a case like this, you would want to see it pull back into 38.20 and volume dry up, and then that might present a much more low risk entry point. So I think that's something to look at. But that's generally how I would approach these, because I think they can't just shoot back up. I mean, that'll happen occasionally, but if they're really going to work, I think they need to settle in and work off some of this overhead. Shop is another one to look at. I was looking at that last night. That's actually holding in. It's kind of thin, though. It trades 334,000 shares a day, so It's a bit thin, sort of could be a double pod though, so that's something to watch out for. And it's acting okay, but they were named. What was the news on them? Do you remember that, Dr. K? Google or somebody named them their #1 store
Yeah,
application developers. I don't know.
I believe that's right.
And that's big news. So that's probably a big positive. But I'm puzzled by the low average daily volume. I mean, you saw some pretty good volume here, so maybe that means now you're going to start to see that pick up. But if you look at the 50-day moving average of volume, it hasn't really picked up appreciably, which is a little puzzling to me. So, yeah, I don't know. It might work, but if you wanted to buy it, then you would use a 10-day line as your tight stop, and I think that keeps you out of a lot of trouble. So it's doable if you want to test alongside. If you think we're going to have a bounce, because I definitely will trade the long side. I mean, on this long last move to the upside, I traded FIT, and that was a very nice trade. It more or less coincides with this move here in the NASDAQ right here. And I got this move in 4 days, 32% I think it was I got off of that puppy, and that was a beautiful thing. So you can get playable rallies within an overall bear consolidation when you get the rallies back to the upside of the consolidation. So you have to be a little fearless, but I think in addition, on a more practical level, you also have to be able to identify a reference point for a tight stop. So it can work, and I think if you're an aggressive trader and you're nimble and you're smart and you are not emotional in that you're going to stick to your stop, you can try anything. I think the problem with most people is they're too busy trying to slap labels on things to develop comfort. Like someone wants to know, is something this a pocket pivot? And if we say it is, and they're going to run out and buy it just because they can put that label on it. But I think there's a lot more to it than labels. To me, a pocket pivot is not a label you slap on something. It's more an expression of a condition in the stock, and then you have to figure out how you might handle that on that basis. So here we're trying to rally back on the Dow. Let's see, the Nasdaq coming back up towards the highs. So we're sitting here. This move here was probably foreseeing the weak jobs number, and now you're going to drag in a bunch of shorts, and they're going to push them out. So let's see. India's central bank cuts key interest rates by 50 basis points on September 29th. Yeah, I know that. So what, Gar? What does that mean? Buy Indian stocks? Should we buy? What are the big Indian stocks, Dr. K?
Big Indian stocks. Good question.
What's that? What's a car company? I forget.
Is it Tata Motors?
Tata. Yes, I like that. Oh, what happened? Did they stop trading? No. It's eSignal has suddenly decided it's going to take its sweet time about bringing up the quote. So what else is new?
Actually, I think it's a different quote. I don't really look at them,
ETA?
so.
No. Help us out, somebody. Look it up. How about let's just buy Mobileye. I think Mobileye is going to go to the 50-day and see FIT. I'll buy FIT.
Oh, here we go. It's TTM.
That's it. It just came to me. See, I felt the wave coming out of your brain there, all the way from South Africa, Dr. K. Yeah, that looks kind of dumb.
Ride that wave.
I don't know. Maybe that means it's going to rally. Ride that wave. Yeah. All right. What else? Twitter. Let's see Twitter. I guess their old CEO is coming. I look at this as a short, so it's rallying here, and I've actually been putting out little bits every 10 cents it goes up. So I think I'm up to like, I don't know, 6,000 shares here. We'll see if it rolls over, but it may not. So, but I don't know. Twitter sells at a wildly cheap 73 times forward estimates. So I guess everybody's all over that today. They see it as a big bargain. So this is kind of interesting. Look at the way this market's coming back. So an intraday sell-off that's maybe they're just trying to drag in the bid. I think the other thing to watch for is a lot of people were expressing regret on TV, watching the financial channels in the afternoon. That's one of my hobbies, but it's kind of like comedy channel for finance. People expressing regret that they missed this low, and this is a great low, and the buying opportunity of a century, blah, 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 blah. And so now you're seeing everything come back. So you may have some people thinking that they got to get in here, because if they don't, they're going to miss the boat, and and this is their chance. So I think they can work that bid if in fact we're starting a new bear market, which I think there's a good possibility. But like I said earlier, you could just chop around for a while, and that sure as heck would not surprise me. So I don't know, I've gotten used to the volatility in this market. It doesn't really surprise me. Expect the unexpected. Don't get too giddy when you start making some decent profits on the short side and just bank them. So, and that's worked for me this year. So day 4 of a rally attempt, follow through nonsense. Yeah, I guess so. If it actually, I don't know. If you consider this the low, then you really would be in day like 79 or something. I don't know. What have you? If you were gonna use a silly thing like a follow through, Dr. K, and the strict definition based on the rules, you have to hold your nose when you say that. I have to follow the follow through day rules. And would this be a third day of a rally attempt or a, let's see, 1, 2, 3, 4, 6. I can't count that many bars. I'm getting dizzy. Let's see, 10, 15, 20, 25. It's a 28th day rally attempt off of the late August lows. Would you say that, Dr. K?
You know, I would, well, when you have it doesn't really matter at the end of the day. But yeah, I mean, for those who want to count this stuff, now this is more of a third day attempt.
Yeah, but I mean, the bottom line to me is who cares? If you show me a setup I can buy, and I will use the ugly duckling corollaries, you know, the bottom fishing pocket pivots, the roundabouts, the bottom of the pod sort of setup, potential bottom of the pod, because you never know whether something's really going to come up sharply up the right side of a big pod. You know, like we played, I think I've talked about this many times, but just to kind of bring it up again for anybody who's new, you know, we played this rally in Mobileye, okay, and this was a decent rally to play all the way up, and then of course it was a short here on the fade, but that was this move up the right side of the pod. So when you get into a market where you're seeing a lot of this, and you start seeing some turns, you might start to hypothesize that you are in a phase where a right side pod rally might occur, and so you can come into a stock on that basis, assuming you have a reasonable criteria for buying it, and also a place where you can keep a tight stop. I think keeping tight stops is critical, and it's the one thing that I've really had to work on, because back in the 90s I could get away with dropping 30% because I can make it back up in a couple of weeks the way the markets were, because you were in a huge secular trend to the upside. And these days, if that happens, it's a little harder to do. And so my focus over the last 4 or 5 years has been on risk management and trying to work out ways to capitalize on significant upside, but not exposing myself to big downside by sitting through some, you know, big drops that occur from time to time. And I think that's really the key in this market, is having tight stops, whether you're working the short side or the long side. Let's see, SJB, short high yield? I don't understand. Oh, what is this? Oh, it's probably rallying because rates are going to stay zero. The dollar got tanked this morning. It's a good short this morning as well for anybody who follows currencies. Somebody says, appreciate both of you guys sharing your trading experience with us. I personally need more screen time to learn how nutty markets can be. Gil, is the market acting just as crazy in 2000, 2008? I think it's acting as crazy as it ever did. And what I wouldn't do is get involved in asking whether you know, it's as crazy as this environment or that environment. I think I would just focus on what the stocks are doing and operate on that basis. So that way you don't have to think about what the indexes are doing, because if you do, it is, you know, when you look at the charts, they look pretty nutty. And I think if you looked at the charts this year, you probably would just do nothing, because you'd just be either terrified or confused or both. And I think the bottom line is just watching the stocks, and that's been a different way for me to operate, is on the basis of the stocks and less on the basis of how many days we are in a rally attempt, so I can start counting for a follow-through day, so I can get a green light to start mindlessly buy stocks, because that's what I really want to do. I don't want to think. I just want someone to tell me, oh, it's okay to buy stocks, so just proceed. over the cliff. And I don't really like that anymore. I don't think that really works. So like I said many times, I think CanSlim is dead. And I think anybody who follows it is basically just a member of a cult. And I think the organization has built they built a business around a very rigid system, and so there's no flexibility there. You know, you got a paper that's based on one particular system that doesn't work anymore. And we talked about this many times. Back in the old days, you know, when the stock had 5 or 6 quarters of earnings over 20%, that's what you're looking for. Not many people could see that. The data wasn't readily available, but now everybody knows about it. So where's the advantage? Where's the edge? There is none. Everybody knows what's happening. Everybody sees what's happening all the time. So you have to anticipate a little more, and you have to be a little more creative, especially since we're trading against machines these days, and the only advantage humans have over machines is that we're creative and they're not. So you've got to work your edge, you know, to identify your edge, and then you got to work your edge. It's one of the reasons why I no longer use Wanda. I use High Growth Stock Investor, because that system allows me to implement more creativity in my approach to the market. So, you know, anyways, blah, 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 blah. GDX, those are the miners. Well, they're trying to come up because gold is. GLD's, you know, here's the way I look at it is this way. I understand there's a fear bid in gold right now, but you've seen that fear bid materialize several times over the last month and a half, okay? Hasn't gone anywhere. So, in my view, if we really get in some trouble with the markets, then what you're going to see happen is you're going to see gold get sold off with everything else, because everybody's going to have to raise liquidity. And that's basically going to take everything down. And we've seen that happen, right, Dr. Hay? Didn't we see in 2008, and there's an initial movement to gold, and then as everything collapsed, gold collapsed with it. Is that right?
Yeah, I mean, gold collapsed probably the least because it is as we know, you know, a fear factor of buying into gold. So it did collapse the least, but it collapsed nonetheless because there was nothing was standing in late 2008. Everything came off.
Yeah, I think let's take a look at this. I'm going in the Wayback Machine. Does anybody remember Peabody and what was that? The professor, Mr. Peabody, and I'm dating myself now. Okay, yeah, here we go. Here's April 2008. Yeah, you see, gold broke down in March of 2008, then rallied, and then when the market blew apart, it started to rally, and then it just blew apart with the market. So then it chopped around, then it came out, and then it became, because of QE and everything, it started its big run. And I think the market direction model caught that along with the move in silver, so that was a good move. 2011. Anyways. Dr. Kacher. Whoa, how formal. Just call him Dr. K. Or just, hey you.
Yeah, that sounded weird, actually.
Have you compared the Nikkei the past 20 years versus how the markets are acting with QE? Not really. Have you? No. Does it matter?
No, I mean, I know what you mean. Yeah, of course, I have looked at the Nikkei and just seen what all you know, the government mishandling of their markets, and you know, obviously I know what the Nikkei looks like since 1990 when the market topped, and it's really, you know, spun its wheels since then. You know, 2.5 decades of a lost economy. But I mean, it's not going to, you know, the U.S. market's going to do what it's going to do. I don't see any profit potential in terms of trying to compare the two markets and seeing if you can mix and match up any of the patterns. I don't expect that at all.
Right.
But I wouldn't be surprised if the Japanese market, which has been spinning its wheels, it's a contagious force, and the U.S. Market may be spinning its wheels too for a prolonged period of years. We'll have to see.
Yeah, I just went over why I think that's all kind of pointless. You just focus on stocks. So here's another one, F5. This is actually a good short up in here along the 50-day, looking for a rally, probably up to the 200-day here. I'm just going through some of the things that have been on my short list that have actually worked pretty well. Here's Workday on a breakout to the downside, but now it's trying to rally. Maybe it goes to the 50-day. Some of these things are looking like they might want to rally, but I'm not so sure. I mean, like I said, you're way down here, so you're in a position to rally. If you continue lower, that's going to be pretty bad. So you know, the real problem is, okay, how do I avoid getting into big trouble if the market snaps back to the 50-day? And if we do continue lower, how do I get in position on the short side? And the answer is very simple. Stay disciplined and pick the right spots and wait for your spots. So, you know, would I be shorting workday here? I think 674, that's been a high before resistance. Maybe that's where it's at. It goes a little past the 200-day. What about, we looked at Mobileye, we looked at Tesla. I think Tesla's kind of down there. And I would look at rallies up now into the 50-day, right? What else? What else? Data. You also have earnings. You see, that thing's been down and dirty for a long time, so you can't really come after that. I think where you're looking at is some of these big stock names on these rallies, because if we do get another break in this market here, so looking over here at the NASDAQ chart, if we do get another big break to the downside, I think you're going to see some of these peel away now. Now that they've broken through the 50-day, they're going to peel away from the 50-day. So price line already started to, but the rally may make it shortable. You see the market rolling back. That doesn't surprise me. So, you know, that's why I'm still, what I'll do, like I'm working a couple of shorts and things that are on my short sale watch list, like Twitter, but I'm putting it out real slow in little pieces as it rallies, and I've got a point where, you know, I'll cover it. It's actually much higher, and I'll just do that. If it starts to work, excuse me, then I'll come after it a little more heavily. So, somebody says, Dr. Peabody, I go back to Roy Rogers. Roy, yeah, I remember that. Sheriff John, Engineer Bill, everybody remember that stuff? No. Or like my kids, all I remember is, who are those Teletubbies? Yeah, that's right. Teletubbies and SpongeBob SquarePants. So, let's see. Somebody says, thanks for the recommendation on the Wyckoff books. They are really good. Also, after reading that, my friend told me the new book out, Jesse Livermore, Boy Plunger, is very good. It is a new book on Livermore. Really? There's a new book on Livermore out there and I haven't seen it? I'll have to check that out. Thanks, Sam.
Yeah,
I love reading about Jesse
Livermore. Livermore books I've found. I've read a few of them, and yeah, about his life and etc. And yeah, so far they've all been worth reading. So if there's a new one out, that might be worth a look.
Yeah, you just can't get caught up in it. It gets kind of depressing at the end. The beginning, though, is really encouraging. So, but what happens is he becomes, in the beginning of any book you read about Livermore, he becomes your model for how you want to be, and then at the end he becomes the antithesis of what you want to be. So, and I think that means keeping things in perspective, or at least using manic depressive medications for bipolar or whatever. I don't know. I can think of better ways to commit suicide too, actually. I'd actually like to die in a hang gliding accident. That's what I would do. Straight up, straight down. Let's see. Kind of like this market. Let's see. Somebody says, I go back to Howdy Doody and Buffalo Bob. Holy cow. Time to pack it up, Chuck. Boy, everybody's coming out with all the shows they used to watch. We got an old crowd here, so no SpongeBob SquarePants types. So, interesting. I guess the millennials don't like the stock market. Not that I can blame them. All right, where were we? LinkedIn was pretty good, I thought, at the 50-day. But again, you know, we talked about these last week, and here you had a rally right up into the 50-day on Friday, last Friday, and now you're coming down. Now you're on top of this structure, and you're going to notice that that's similar to PANW as it comes down into a structure. So it's in a position of balance. If it broke, that would be pretty weak, and I'm not saying it couldn't, but I would prefer to be shorting these further up in the patterns, and I think that's the case. Does anybody have any questions about anything they're watching on either side of the market that we can look at before we hang it up? We have 9 minutes left, maybe 10 if we want to push it. Come on now. We got to play the Jeopardy music. Do 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 do. MNST. Okay, I like that. That's something. I think I've hit my screens a couple of times. Oh, what a dog. Yeah, maybe that's the low. It's undercutting the 200-day. If you shorted it, you'd want to use the 200-day as a really, really, really tight stop, which is doable. There's always a possibility that, it's looks like a head and shoulders-y type of formation. Yeah, I think if you're going to short it, this is a spot to short it. You know, again, you have to really anticipate on the short side. And What's difficult about that is oftentimes when a stock is in position, the market might be rallying hard, and so you're afraid of coming in. But you kind of have to put what the market's doing out of your mind, and you have to focus on what the stock is doing and operate on that basis. And I would say even on the downside. So when you have a market moving to the downside like today, I'm still focused on the setups that I consider actionable and in a position that present low risk in terms of setting a stop, or at least having a reference point that's nearby that I can use for a stop. Let's see, Chinese names like JD. Oh, some of these are so ugly, it's not even funny. Trying to turn, though. Notice you get this sort of bottom fishing pocket pivot here 3 days ago, coming up through the 10-day and the 20-day, but it's below the 50-day. Now we're going above the 50-day. They're trying to come back. But, you know, some of these are so beaten down, a reaction rally would not surprise me. So this one's, there's no real sign of a low yet. It's just kind of trundling around. And for all you know, we might blow apart. NVIDIA, there we go. Now we got something. That's actually acting pretty well, pulling into the 10-day. It's a little bit, you know, look on the weekly chart, a little bit of this, you know, straight down, straight up sort of thing. But it's pulling into the 10-day. I'm not sure what the impetus is to buy this. I'm a little leery of the chip stocks in any case. So I don't think that's where I'd go. If I was going to buy something, okay, the way I would look at it is what if the market's bought at a low, saying its pattern. Okay, so let's say let's theorize here, and this is what I like to do. I like to play what ifs, only in the sense of what is. Got it? Okay, not strictly in the sense of what if, because we know what is happening here is that we're at the lows of a potential range. So, given that, what is happening with individual stocks that might be turning around within their pattern? So again, we can look at, and I think this is a good pattern to look at, SHOP, because that is setting up, that's constructive. I don't see anything negative about that. If we were in a roaring bull market, that would be very tasty actually. And the way it's drying up, volume drying up today in the extreme, let's see. Let's look at the stock on my, whoops. I gotta go.
By the way, it was Amazon they did the deal with. Amazon.
Yeah,
So
that's right.
that explains
Let
a
me
nice jump.
go. I'm just gonna go to all securities. Yeah, I know there's a quick way to do this, but I'm still not that facile with it. I've been getting good with everything else. So you can see they put the volume levels intraday here. So I mean, to me, this totally replaces MarketSmith. If you're using MarketSmith, I think you're a putz paying $1,000 a year when you could pay $599. You know, and take your wife out, or your husband, or your, you know, if you're same-sex boyfriend or girlfriend, whatever, take him out to dinner with the money, you know. What was I looking at? Shop, yeah. Let's get big here. We're gonna blow it up. Where's my blow up button? Here we go. Trading, you know, 60% below average right now. That's a voodoo day. That's a volume dry up right at the 10-day. So everything's turning code blue. That looks pretty good. We'll look at stuff with play. Well, we already looked at play. So, like I told you guys already, this sort of break to me implies that you might need to pull back, but you kind of did that this morning. So, you know, maybe but you had to buy it probably there. It's also kind of thin, 508,000 shares, but maybe worth a whack. But it's turning off of a low of a pattern. This is the sort of stuff I'd be looking for. Nothing's breaking out. Somebody says, quite frankly, HSI does not charge enough for the product. Shh! Don't tell them that. You know what? I think they're trying to create something that adds value and the average person can afford. Because, you know, people can't afford to spend all that much money. We've deliberately kept our prices pretty low. And we've had a lot of people come and tell us, you need to raise your prices, they're too low, they're too. But, you know, my objective is to try and help people out at a reasonable price. And the cash flow from our businesses is enough to pay my bills, and more than enough, and I don't have to touch money in my own accounts, and I can do and make my big money trading, which is where I make my big money. So it works out. I don't need to gouge people. No, we should charge people $29,995 for our new How to Buy IPOs webinar. And then anybody who thinks
Level 2.
I remember we had one guy, some broker from Merrill Lynch said, your service is overpriced, you charge too much. And my response is, blank you. Personally, I think if you're paying $100 a month to get to listen to me go off on rants once a week, I personally think it's worth at least a couple of thousand myself. So I actually have a degree in ranting. Well, it's a minor degree in ranting from Stanford. So I always figured I could fall back on that if my econ degree didn't work out.
Yeah, it's called the BS.
That's right. That's the BS part of it. I don't know. This one doesn't really get me excited. Come on. Give me something. No, not Apple. Apple's looking like it wants to bounce. Maybe I'll just cover this thing, get out of the way, and let it. Yeah, and then what'll happen? It'll bust wide open, right? The other thing is you got to give your positions a little bit of room, I guess. I think maybe. What was it? Oh, AAP. Oh, isn't that Advanced Auto Parts? Yeah, there's a Bible gap up, but I'd rather be buying it closer to the low of the Bible gap up. And of course, it's a breakout, and we know where breakouts go. UA is one someone's asking about. Under Armour I saw an article on the front page of IBD today talking about how they're going to become the I don't know, the device retailer. They're going to all their clothes are going to have chips in them, so people can tell how many times they run around the house or how many times they use the bathroom in a day. I don't know. I saw the Fitbit thing, and I thought it was interesting. The fellow showing it to me was how, look, I went up 32 flights of stairs today. It's like, yeah, but you still look pretty heavy to me. So, like, you know, like Bill O'Neill used to say, what is the end result? But anyways, I think UA, there was some article about that whole concept of using devices and apps that are related to fitness and building that into their clothing line, I guess. And what I see here, it's trying to hold the 50-day, and so you're getting a little punch to the upside. Maybe it's shortable here at the 20-day. You know, it could come out of it. That's a possibility too. I wouldn't discount that potential. So, a good company, I think. I think they're on the right track. Somebody says, true, you guys are great value as well. I like to think so. I mean, I got guys, I had dinner with an old institutional client at O'Neill who thought we should go institutional. And, you know, instead of giving away everything for 50 or 75, whatever it is, bucks a month, you can charge an institution 50,000, 100,000 just to talk to you. That's what we used to do at O'Neill, and I have no doubt I could probably try and do that again if I wanted to. Then you only need
Yeah, I mean,
20 clients to make $1 million.
It's economy of scale, and there was that site I didn't want to mention. I'm not going to mention them because I said something negative about them. But no, they do have a corporate. They do that with institutions. They have institutional rates, which are much higher than what they charge. You know,
right? I don't know.
It's economy of scale thing.
I don't know.
So I don't have anything against that site doing that. It's fine. You know, because the institutions are institutions. The only issue I have is that site has been fumbling.
Somebody asking about this one.
But they're still around. They're one of the few.
Here, I want to get to a couple of questions here.
Which one?
NAT. Let's see. NAT. Nordic American Tanker Shipping. I don't know. Cheaper stock. Trying to come out. I guess if you bought it, you'd use the 10-day line as your quick stop or the 50-day line, I suppose. I don't see a lot of things looking good, but let's do this before we end.
I'd be careful with NAT. It's in the oil sector, and I mean there's been a lot of headwinds for oil-related stocks. So.
It's actually, we've been going for an hour, but I'll look at one thing here. Look at the stocks that I look at on the upside. So I'm going to sort them by ERG. See what's shaking here real quick. Cal-Maine Foods. There's Salesforce again, looking pretty good. Martin Marietta, nah. Here's another one. Edwards Life Sciences trying to come up. You're seeing a lot of this kind of stuff, which makes me a little bit wary. Consolidated. And these are the highest ERG rated, so it's comparable to the composite rating. And it works. It totally works. You know, I wouldn't get wedded to the O'Neill rankings. They're okay, but there's a lot of ways to look at the market. And I think anything that just gets you into the ballpark is really what you want to see. Let's see. Radius Health again is looking pretty decent. Silicon Motion. This one's trying to turn. See that? That's kind of ugly though. Yeah. It's coming off a deep position here. Maybe that has some potential. They're bringing it up. Maxilinear, there's another one. That's a cheap stock though. You can write some of these down, but you can also look at this on HCSI yourself. I just create a screen up on volume, erg over 150 or 1670, something like that. What is the screen? Yeah. I think the one thing I'm wary about, I'm watching this trade, the way this tape looks, it looks like I said, they can drag this sort of bottom fishing bid in here, and everybody it's sort of a greed thing because they see the market back down where it was in late August, and they're going to come after everything here. And they kind of lead them in, and then they pull the plug or pull the rug out from underneath them. Pandora's trying to turn. I don't really see a lot here today that's up on volume. There's a few things. I think we've looked at them. The shop looks okay. Maybe you could try the fit. I don't know. It's down right now. But a lot of these look like, quick draw McGraw type trades. So somebody says Nat may be benefiting from the need for oil storage. Possibility, yeah. So, but it's still not really something that I would look as conceptually compelling. That'd be good for a few bucks. It's only what, 8:34. They're gonna get everybody excited, and then they're gonna pull the rug out. We'll be down 500 by the close, right? And that's pretty much it. That's up on volume today. So let's look at another list. We can look at the things that I've been putting down as potentially buys. We'll remove the filter and sort them by erg once again. So Headwaters, nah, that was looking good a while. JetBlue is hanging in there. Paycom trying to recover, but still looking ugly. Luxoft, there's really not a lot here. I'd probably go for the thin things that might get squozed or squeezed. We say squoze. Past tense. Yeah, trying to push it. Maybe, yeah. I think the best you're going to do is look at some of your short sale targets in reverse, maybe, or some of these bottom fishing things. The Radius Health, again, that comes up. Does Under Armour go higher? Maybe it does. Here we go. They got them pushed pretty good now. Netflix, maybe it's going to rally to the 50-day. Maybe it's going to turn. It's been holding tight, so that's one that possibly it could be a trade. Fortinet is underneath everything. That's kind of weak. PNW, maybe it's going to try and rally. You might get a couple of bucks out of that. Expedia, nope. Tesla, nope. Axovant, this AXON, interesting story, but I don't know. The thing with biotechs is you wake up one day and you're getting hit because Hillary Clinton's babbling about whacking them with price controls, and that's pretty much it on my watch list right now. So there's not a lot here, so I wouldn't get overly excited to get long. You're probably better off waiting to see if we get a rally that's shortable and we get another leg to the downside. So, but things can change over the next few days, so I just kind of keep your short list of potential buy situations. We saw a few of them. There's a small handful of them, so you could look at those, and at the same time watch the rally for potential short sale points developing in some of these stocks that we were looking at earlier, which are rallying back up towards their 50-day moving averages. And remember, I'm talking about some of the bigger stocks because now that they've broken below the 50-day moving averages, a rally back up may put them into short sale position for another leg down in the general market, and that may be what causes it. Anyways, so that's all I've got for now, you guys. Somebody says, our stocks are the high erg, the place to look in this market. I usually use a minimum erg, so either that or I'm looking at my old prior buy list where I'm looking at stocks that, and I save all my old buy lists, where I'm looking at stocks that were former leaders that have broken down and looking pretty ugly, and which maybe trying to turn off the lows, like the Fitbit was one of those types of situations. So anyways, that's all I've got, you guys. Hopefully it's been helpful today to give you some direction in an otherwise funky market. Dr. K, anything else before we sign off?
Yeah, I mean, just remember as always to stay fluid, especially in this kind of topsy-turvy, elevated volatility environment. And so have your watch lists ready on both sides. We'll continue to run our screens, of course, and act accordingly to however the names stack up on either side of the equation.
Okay, sounds good. All right, you guys, we'll catch you next week. Have a great weekend.
Take care.